Welcome to The Explainer. I am so thrilled to have you here with us today. Okay, let's just jump right in, shall we? Today, we are looking at the absolute ultimate guide to navigating highly volatile markets and, let's be honest, surviving those grueling prop firm competitions. We've actually pulled together data from funded trader platforms, brokerages, and massive trading tournaments to build exactly what we're calling high-stakes trading, the survival playbook. If you were trying to keep your capital safe and actually get funded, well, you are in exactly the right place.
So let's start by asking the big question right out of the gate. Why do most traders fail prop firm challenges? It's a brutal reality, but most people who attempt these challenges just do not make it to the funded stage. There's this super persistent myth out there that traders fail because, they don't have the perfect entry strategy, or maybe they aren't using the exact right combination of technical indicators. We obsess over finding the precise moment to click buy or sell, but the data actually tells a completely different story.
5%. That's the magic, or maybe tragic, number. According to an FX Street survey of prop traders, hitting the 5% maximum drawdown limit is the absolute ultimate account killer. It is not bad entries. Your entry strategy literally doesn't matter if you hit this drawdown limit first. You see, when a prop firm tells you you're trading a $50,000 account, you aren't actually controlling 50 grand. You are controlling the drawdown limit, which was typically just 5% of that notional value. So really just $2,500. If you risk the same amount as you would on a personal account and you hit a completely normal string of, say, 5 losses. On a prop account, boom, you are completely out of the game.
So how do we build a real defense against that? Well, here's our agenda for today's explainer. Number 1, the reality of trading. Number 2, mastering your mindset. 3, surviving volatility. 4, winning competitions. And 5, prohibited practices. All right, let's dive right into section 1, the reality of trading, myth versus math. To survive these high-stakes environments, that whole get-rich-quick mentality absolutely has to go. It is downright toxic to your account balance. We have to replace the myth of overnight millions with the cold, hard math of risk management. Just take it from Marcos, a 22-year-old funded trader with the Fivers. He said, "I pass with a winning ratio below 50%. Ditching the get-rich-quick mentality is a good way to maintain a stable trading career." I mean, really think about that for a second. He loses more trades than he wins, yet he successfully passed this challenge and now manages a $24,000 funded account. He completely proved that you absolutely do not need a sky-high win rate to succeed. What you actually need is an ironclad system for managing risk. And that brings us to the golden mathematical rule for preserving your margin: 1.5%. Never ever risk more than 1.5% of your account margin on a single trade. In fact, many highly successful tournament traders keep this between 1 and 3%. By strictly capping your risk per trade, you ensure that even a brutal string of unavoidable losses won't trigger that dreaded maximum drawdown limit. It's all about staying in the game long enough for your edge to actually play out.
Moving right along to section 2, mastering your trading mindset.
Psychological survival is every bit as important as mathematical survival. Trading is not about just waking up, grabbing a cup of coffee, and going with the flow. No way. It is a strict, demanding job that requires intense discipline and a really structured environment. So here is the chronological daily routine of a professional trader to help enforce that. Step 1. Check your daily target in the economic news from the night before. Step 2. Analyze those pre-market charts, identify your bias, and mark your key levels. Step 3. Trade the plan during market hours, and this is critical, take a break at noon when the volume drops. And finally, Step 4. Conduct a thorough post-market review of your trades and document your conclusions. This daily structure is exactly what prevents those impulsive, account-ruining decisions.
And a totally crucial part of that disciplined mindset is treating your trading losses as a perfectly normal business expense. Every single trader loses money. It is simply the cost of doing business in the markets. If you don't accept this rationally, you're going to fall right into the trap of revenge trading, trying to immediately win back exactly what you just lost. And that almost always leads to an emotional spiral and a completely blown account. You just have to embrace the loss, review it, and move on.
Let's shift gears now to section 3, surviving volatile markets.
Listen, volatility completely changes how markets behave. Price moves become faster, much wider, and significantly less forgiving. A setup that works like a charm in a calm market can literally destroy your account when volatility expands. So you can't just trade more aggressively. You actually have to adjust your risk controls. First off, reduce your position size. Because price swings are larger, your dollar risk increases automatically. Smaller sizes keep your risk consistent. Second, use wider stops based on actual market structure, not just some arbitrary numbers, because tight stops are just going to get triggered by normal market noise. Third, take fewer trades and just wait for cleaner confirmation. And finally, set strict daily loss limits to prevent chain reaction of bad, frustrated decisions.
Now, you also have to adapt your specific strategy to the type of volatility you're seeing. Breakout setups, those are ideal for strong directional momentum, like when the market reacts to major economic data and the price just breaks key levels with serious conviction. Mean reversion, on the other hand, well, that's for unstable, overstretched moves where the momentum slows down and the market gets all chaotic and two-sided. Your strategy choice has to follow the market's actual character, not just what you prefer to trade. Using a breakout mindset in a chaotic, choppy market is, well, it's just going to get you chopped up.
All right, Section 4. Winning high-stakes competitions.
Trading in a tournament is literally a race against the clock and hundreds of other traders. We've got data gathered from analyzing over 50,000 tournament participants, and here is exactly what separates the winners from the eliminated. First, focus on just 2 to 3 familiar instruments. Please don't jump around 50 different pairs chasing moves. Second, trade during peak volatility, specifically those London and New York overlaps, because that's when the really decisive, high-volume moves happen. Third, maintain a minimum 1 to 2 risk-reward ratio. In tournaments, one big winner is worth way more than a bunch of tiny ones. And fourth, I cannot stress this enough, ignore the competition leaderboard. Checking it just makes you emotional and forces you to abandon your own game plan just to catch up.
Okay, so your absolute ultimate defense mechanism for tournament survival is the drawdown schedule. This is a strict mathematical framework that dictates your position sizing based on your current drawdown. Check this out. At a 0 to 3% drawdown, you trade normal sizes. If you drop to 3 to 5%, you've got to reduce your size by 50%. If you hit 5 to 7%, you drop to the absolute minimum position size, taking only your absolute best A-plus setups. And if you cross 7%, you pause trading entirely for 24 hours just to reset mentally. This adaptive approach is what keeps you alive while all those overly aggressive traders are blowing their accounts.
And finally, Section 5, prohibited practices to avoid.
You know, survival isn't just about managing the market. It is absolutely about playing strictly by the prop firm's rules. These firms are looking for genuine, individual traders who can actually navigate multiple market conditions. Strategies that attempt to abuse the system, they will get your funded account instantly terminated. Take arbitrage trading, for example. This is the exploitation of price discrepancies or glitches across different markets or identical assets. If a platform's data feed lags and use software to guarantee a risk-free profit based on that little glitch, well, that's arbitrage. It's not real trading, and it is strictly prohibited. No way around it.
Another totally forbidden tactic is bracketing. This involves opening pending buy and sell stop orders right around the release of high-impact news events. The goal here is to artificially capture the massive, instant volatility spike without actually analyzing the market direction at all. Because it's trying to exploit the execution mechanics during low liquidity events rather than trading the actual asset, yet prop firms will absolutely ban you for it.
Let's rapidly run through a few more instant account killers. High-frequency trading, or HFT, where trades last mere seconds or milliseconds, that's out. Tick scalping is strictly prohibited. Copy trading or coordinating trades with a group to manipulate exposure is a massive violation. Using account management services, which basically means paying someone else to pass your challenge for you, is strictly forbidden. And finally, one-sided bets, where you just blindly hold positions in only one direction regardless of what the market is doing because it shows a total lack of a real trading system. Break these rules and your funded career is instantly over.
So as we wrap up this explainer, I really want to leave you with one final provocative question. Will your trading strategy survive the math of the market or just the myth? You now have the complete survival playbook. You know that protecting your drawdown is way more important than having perfect entries. You know exactly how to adapt to volatility, and you know the absolute rules of engagement. The math is right there in front of you. The only question left is, do you have the discipline to actually execute it? Thank you so much for joining me on this explainer, and I'll catch you next time.